Hi, this is Amin, a California-based registered investment advisor. This week, earnings reports from Nvidia and Walmart gave us a peek into what's happening with the American economy. The news was a mixed bag of booming tech and cautious consumers, all wrapped up in a fragile stock market. Nvidia's earnings showed that the artificial intelligence revolution is very real. The company posted record revenue of $35 billion, nearly double from a year ago, with its data center business fueling most of that growth. This part of Nvidia makes the powerful chips that run AI. Nvidia's CEO said the company is on track for $500 billion in revenue through 2026. He also addressed concerns about an AI bubble, pointing to huge ongoing shifts in technology. Basically, companies everywhere, from tech giants to smaller businesses, are investing massive amounts in AI infrastructure and driving innovation. For the wider economy, this spending represents a big wave of business investment that could keep things humming along for years. Meanwhile, Walmart's strong earnings offer a window into how everyday Americans are handling their finances. The retailer beat expectations and raised its outlook with a 27% increase in e-commerce sales. This shows that people are still spending, but they're being smart about it. Walmart saw more business from households earning over $100,000, suggesting that wealthier shoppers are looking for value. While middle-income families are holding up well, lower-income households are feeling more pressure. The company is using AI to improve efficiency and boost online sales, and it's even moving to the tech-focused NASDAQ stock exchange, signaling its transformation. But there is a potential problem on the horizon. Walmart warned that new tariffs could lead to higher prices, which could add to inflation just as things were calming down. The company will try to absorb costs where possible, but some price increases might be unavoidable. Taken together, these reports show a two-speed economy. On one hand, you have massive corporate spending on cutting-edge AI technology, promising future growth. On the other, you have a careful consumer base drawn to value and necessity, with potential new inflation from tariffs looming. This mixture of excitement and anxiety was on display in the stock market's wild reversal this week. On Thursday, the market opened with a bang, celebrating Nvidia's strong earnings. But that optimism quickly faded, and the market ended the day with a steep decline. Here's what likely caused that dramatic swing. 1. Valuation concerns. After the initial cheer, investors started to worry again about how expensive AI stocks have become. The sell-off was quick, showing that even good news can't fully erase the fear of a bubble. 2. Fed uncertainty. News from a delayed jobs report caused confusion about whether the Federal Reserve would cut interest rates in December. This rattled investors as tech stocks are especially sensitive to changes in interest rates. 3. Crypto chaos spills over. Sharp recent declines in the crypto market also played a part. Some traders who used borrowed money to invest in both stocks and crypto were forced to sell their holdings to cover losses. This deleveraging pressure amplified the selling across the broader market. This kind of volatility reveals a market that is heavily dependent on a few big tech names and is prone to quick shifts in sentiment. It's a reminder to stay cautious as big swings can happen quickly. The underlying market is showing signs of stress, even as the excitement around AI continues. One last point on strategy. Given all this market choppiness, having a reliable tactical strategy in your toolkit is important. The one I use looks at volatility, as defined by the VIX index, and moves funds into defensive sectors like consumer staples, think the basics of toilet paper, toothpaste, and food, when volatility rises. Back on October 31st, this strategy signaled a move into consumer staples at the close that day. That turned out to be a good call, as the S&P 500 has fallen 5% through Thursday's close. The consumer staples sector actually gained over 1%. As the old saying goes, better safe than sorry. And in volatile markets, sometimes a defensive play can be a smart move. That's it for this week. Next week is holiday shortened with markets closed Thursday and a half-day session on Friday. Stay tuned for the next edition, and as always, your feedback is welcome. You can find my email in the show notes. Thanks for listening, and happy investing.